At the start of 2022, I said this was going to be a pivotal year because I knew what was happening in 2023. We've then witnessed 12 months of unprecedented economic turmoil and events. The stock market was plagued by extreme volatility and mass insider selling, and the level of social and political distractions made it nearly impossible for people to stay focused on the underlying economic factors. Shocker! Now, the Federal Reserve embarked on a reckless money printing spree, causing inflation to soar, while the dollar has lost a lot of its purchasing power value. Then they decided to raise rates in an effort to slow the economy and solve the problem that they created. Now, both the cost of living and the cost of borrowing has increased exponentially. Yeah, great work, Fred. And days after multiple billions were lost in the FTX meltdown, central banks conveniently reveal a plan to test their own central bank digital currency, a complete heist of personal privacy and maximized control over the public. We then saw the first ever global yield curve inversion in history, officially signaling the collapse on a global scale. Combine this with central banks' struggle to stay afloat with no liquidity, warning of forced selling in the markets, buying up of bonds, and losing their credibility altogether. It's clear that 2022 was indeed pivotal. Now we are teetering on the brink of a global collapse. If you weren't paying attention to this year, you're not already preparing for what's coming. And this is a critical video to watch and share with others. I'll catch you up on the key happenings that have led us to this point and show you exactly what you can do to strategically protect your wealth before any more of it evaporates and we go into 2023. Coming up. What's going on this year? Well, I'll tell you, I think that this year should be probably more interesting than 2021 because it's a pivotal year. It's the year that leads up to LIBOR's supposed final demise, and all 6.10 trillion in notional value contracts have to reset. And we're going into this year with probably an awful lot of volatility and a lot of conflict. So let's just dig right in, because I do think that 2022 is actually a pivotal year, and this may well be the last opportunity that we have to get into proper position to weather it. Because the Fed, to save their credibility, this is really why they're doing it, that they've got to raise interest rates. Now, how much they're going to raise interest rates? How much can they raise interest rates? Because as you can see from this Federal Reserve graph on this is the overnight Fed funds rate, it has been trending down since we went into a full debt-based system. Can they raise the interest rates? Well, you can see that every time prior to them raising the interest rates, what happened was it pushed us into an official recession. Unfortunately for many, even though officially we're no longer in recession, it was the fastest recession in history, a lot of people are still in recession. But what is the Fed saying? Well, you look at their dot plots. So this is the FOMC meeting where they discuss how they're going to and how many times and at what level are they going to raise their rates. And you can see that they expect 3 rate hikes this year. Now, understand, we're starting at such an extremely low level that even with 3 rate hikes, well, you know, what do we have going on? Even with 3 rate hikes, the circumstance for corporations are the interest rates are going to be keep everything very, 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 very loose and very, 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 very easy. And you see right off the bat, starting out this year, you know, stocks are they don't know quite what to do about this. Risks for emerging markets have multiplied this year. global food inflation, oil price shocks. Overall, that's a risk indicator, and you can see that that's on the rise. And the number of countries in debt distress, that will grow. And it'll be very interesting to see. Now, look, if you're sitting in gold and you're sitting in something that can protect you, okay, I mean, it's going to happen. It puts you in a position to take advantage of the opportunities that will present in these markets, but not yet. It's not yet. But globally, investors are scared, right? They just pulled a massive $17.5 billion out of global equities, and they're just getting started. Really? Because you can see that shift, can't you? These are the global equities flows. So this is the accumulation, so much since 2020, right? And then this is the index, and you can see the shift. You can see where the pattern change is happening right now. Investors also pulled $8.7 billion out of bonds, $55.4 billion from cash. Wait, I thought cash was king. Oh, pouring $900 million into gold. And that was before last Friday's stock market wrap. They're going to safety, and it's just getting started. How do you feel about that? Because emerging market bonds have wiped out gains of the last 2 years, count them 2, as the sell-off extended into a 4th month in the longest streak of losses since what year? 2006, as we were setting up for the financial crisis. And emerging market debt sales plunge amid Ukraine war and rising rates. And so developing nation April issuance fell to the lowest in 10 years. They can't sell the bonds, so they got to stop issuing. Wait a minute. Can a government that's got to fund its spending really stop issuing bonds? Or will the central bank just go into this vicious doom loop along with the government, with the banks that are forced to buy the government garbage? Government debt. Surging yields are deterring emerging market issuers because it's getting more and more expensive to buy it. So you've got increased interest rates along with, if they've been issuing or if they want to issue dollar-denominated debt or foreign currency debt, so you have like a double whammy because you have the currency that you must buy to service that debt going up at the same time that you have interest rates going up. No wonder these countries are in trouble. But it's not just over there because we are incestuously interlinked. When will it overwhelm what we're seeing in the derivatives markets? I don't know, but I feel like we're really, really close. Because faced with the impact on sentiment of the intensifying conflict in Ukraine and central banks turning more hawkish, in other words, raising rates, as they try to bring inflation to heel, which hasn't been working very well, developing market borrowers have become more skittish. And they're going to the safety of gold, because gold has been a proven safe haven for thousands of years. And I just pulled these. Both of these are from the IMF. Latin America hit by one inflationary shock on top of another. But is it just Latin America that's being bombarded with inflationary shocks? Because we've been pretty surprised by the numbers here in the U.S. too. And wow, in Turkey, they've raised their forecast from 23% inflation to 43% or something like that inflation. So, and we had the World Economic Forum and the IMF. I mean, everybody's cutting growth and increasing inflation expectations, one shock after another. But here's the real key in this. We'll look at that, and then we'll come back to the key. Price pressures. So this is Latin America. This is the current forecast. This is the previous forecast. So the blue is the previous, the red is the current, and you can see that the current forecast for inflation is spiking, right? Well, and guess what? They're probably going to be underbidding it, or it's probably going to be even higher than what they're forecasting. And here's really the problem for the governments and the central bankers. IMF urges Latin America to address inflation to curb, here it is, unrest risk. Because that's how they lose control and how they lose power. That could work to our advantage, the little people. Maybe we can get a more fair monetary system. If we come together and we say, no, we won't accept this garbage, we won't accept the CBDCs, we got a shot. We got a shot. It's talking about the revolution. We've talked about the revolution potentially starting. In his most recent comments about the highly tense U.S., China, Taiwan situation, we've talked about that, as reported by Newsweek, who asserted that there is a very high probability that there will ultimately be a direct military confrontation. So we have the war between, World War III. Can you see it? Can you see it? He noted that there was a sense of crisis in Taiwan. As the situation of the Taiwan Strait deteriorates, we must prepare for a military struggle. Prepare for a military struggle. A commentary on Saturday urging Chinese citizens to prepare for a military struggle in the near future. When is it going to happen? I have no idea. Is it going to happen? Maybe yes, maybe no. This kind of sounds like it very likely is to happen. So are we going to be dealing with war on multiple fronts? Is this really World War III? Time is going to tell us, but it's the perfect time. War is something that always accompanies a currency life cycle, a currency regime shift. It's those repeatable patterns. That's what the whole strategy is based on. The repeatable patterns that happen every single time. Because I cannot guarantee tomorrow. That's way beyond my control. But I do believe that if something has happened the same way every time and we're doing the same thing, our most likely outcome is we're gonna get the same result. I mean, that just makes sense. So what else is one of those repeatable patterns? Well, gold provides downside protection. This is not rocket science. This is global equities, UK gilts, and gold returns in British pounds during periods of systemic risk. Because gold is a proven safe harbor. And you can see how it's performed. Dot-com bubble, 9/11, Great Recession, sovereign debt crisis 1, sovereign debt crisis 2. Remember, sovereign's government. Brexit, 2018 pullback, and COVID-19. What do you want to be holding? Because this, on top of the end of the currency's life cycle, means that we're quickly approaching a point where the dollar will have zero, count it, zero value. Last, its most widely recognized feature is its potential value in highly adverse scenarios, and it's called the war chest argument, but it's been proven over and over and over again. So I'm good with it. And that's how I'm protecting myself and my family. That's also how I'm positioning to take advantage of the opportunities that present. And there will be many opportunities that present. Because right now, with all of the new money that's been flooding into the system died in 2008. I don't really care what anybody says. It died. And they just put it on life support, and that life support was massive money printing to reflate the targeted assets. Stocks, bonds, real estate, because of the massive amount of derivatives that sits on top of all of it. Minimum 610 trillion notional. Notional means nobody knows the true value at risk. I don't know it. You don't know it. They don't know it. Now, considering that real estate is roughly 30% of the global economy, and they've worked real hard, those global central bankers, to reflate that bubble after it popped in 2008, if they're raising rates to combat the inflation that they created to destroy demand. I mean, inflation is a lot of money chasing too few goods. And with the central banks, it's pretty bad. We know how much money they've just been creating and creating and creating. So here is that report from the Federal Reserve Bank of Dallas. Real-time market monitoring finds signs of brewing U.S. housing bubble. One of the things that I always love is how they never, ever, ever accept responsibility for the manipulations and then the subsequent unintended consequences that come from that. But they say, our evidence points to abnormal U.S. housing market behavior for the first time, oh my God, since the boom of the early 2000s, which they created as well. As this housing market bursts, this bubble bursts, or real estate, not just housing, real estate, you want to be in a position to take advantage of it like the wealthy have. 2008, there was a massive transfer of wealth in real estate from the individuals to the corporations. Well, corporations are doing all of this on debt, and the debt bubble has already popped. Now, they're trying to moderate how that whole thing is imploding, but the big, long debt boom is over. Because, we've been anchored at zero since 2008. And then house prices rising faster than even the rising rents. Okay, what you've been looking at is even though the housing market is cooling off, the prices still were over 20% year over year on average. And in some places like Tampa Bay in Florida, over 35% increase in house prices. Now, you got to have shelter. That's part of the mantra. You've got to have a place to live and maybe a place to make your last stand. But, year over year, 20 and 30% price increases. Yeah, what goes up must come down. That's not happening yet, but I don't think we're that far away from it. Because we're now in a rising interest rate environment, at least for the time being. I don't think that's really going to hold true very long, and we'll see. Maybe through the rest of this year, maybe not. It depends on how scary it gets out there for the Fed. Gets scary enough? Markets implode enough? The prices on housing really start to go down in a very dramatic way, where now you have all of these people that are underwater because the current market value of their homes went down, or commercial real estate went down. We're in deep doo-doo. So who exactly and what exactly do you personally have confidence in? Do you really have confidence in those that are leading us into this abyss and this transition from a debt-based system into a who knows what system? Well, I hate to tell you this, but the markets just got a little riskier. A couple of weeks ago, the Federal Reserve kept promising that it was going to be a 50 basis point move, and then they surprised Wall Street and the markets with a 75 basis point move. And what that really did was tell Wall Street that you couldn't necessarily trust central banks and their forward guidance, which was a key tool that they used since the financial crisis that hit back in 2007, 8, and 9. Well, another one of those dominoes is falling. And the markets, yes, indeed, just got a whole lot riskier, and I'm going to explain to you why. But now the ECB is coming out and saying, nope, we're not going to offer any more forward guidance going forward. Because it ties their hands. If they tell you what they're going to do, then they can't change right at the last second. And they need to be data dependent, even though they haven't been data dependent all the way through this. And the other part that I find quite interesting is the world is starting to wake up to the fact that the central bank creating all those new dollars and euros and yen, etc., is actually a big cause of the inflation that we're dealing with right now. We talked so much about that. But central bank hopes to regain credibility. If they're hoping to regain credibility, is that because they lost the credibility? And once you give that key tool up, it's so much harder to get back. So we've had the Bank of England, the Federal Reserve, and now the ECB all give up their credibility. Let's see, this was those protocols telling the markets what they were going to do. I mean, it tied their hands, the poor central banks. ECB President Christine Lagarde, from now on, we will make our monetary policy decisions on a data-dependent basis. We will operate month by month and step by step. Does this not tell you that they have lost control and they've lost a key tool, credibility? The public belief in their ability to take care of this, frankly, is much, that's the last piece of credibility and confidence left. We are not offering forward guidance. Yeah, step by step. A commitment to forward guidance that has now been ditched after 9 years. The ECB surprised many economists by raising interest rates, despite having guided until recently that it intended a move of only half that size, if any at all. So if indeed interest rates are supposed to tame that inflation, I would say that all the central banks, or most of the central banks anyway, are let me correct that. All of the central banks are way behind the 8 ball. Even those central banks that have been raising rates and raising rates. It's not taming the inflation, because what really created it was the hyperinflationary monetary creation that they've done in all of their QE operations. So my question to you is, what will you do about it? Because unfortunately, it seems like a lot of people are like deer in the headlight, and they're just sitting there waiting to see what's going to happen. But quite honestly, that will not serve you well. The time to get prepared is when you have the opportunity and the access to what you need to do so. If you wait too long, then this inflation will just run you over. And they say, well, forward guidance has definitely overstayed its welcome. Oh my God. They kept being surprised by the data, meaning the central banks kept being surprised because, wow, it was more than the inflation was more than they expected. It was more than they expected. It was more than they expected. Well, first of all, it was transitory, right? Not transitory and a lot more than they expected. They kept being surprised by the data, which affected their credibility. What really affected their credibility, though, was doing something different than they kept telling the markets that they were going to do. Remember, a key tool that they had, they just gave it up. This, to me, is a huge indication of central bankers losing control and trying desperately to get it back. A second council member said the benefit of a June increase was outweighed by the loss of credibility that would have resulted from breaking its guidance on the timing of when asset purchases would end, adding, "It tied our hands." So again, this credibility issue keeps coming up over and over and over again. It's what central bankers fear the most and governments fear the most, because this is a con game, and all con games require confidence. And we've seen since 2008, particularly, banks, the overnight interbank lending, well, banks learned they couldn't trust other banks. That was in 2008, 2009. It was all things discovered in 2012. But 2015, with the Swiss surprise, central bank knows they cannot count on the other central bank. And now the markets know they can't count on this forward guidance. We are much more flexible. So this is what the central banks are saying. We're going to be much more flexible in that we're not offering forward guidance of any kind. From now on, we will make our monetary policy decisions on a data-dependent basis. So again, they will operate month by month and step by step. What are the markets going to do? How can they know what to do ahead of the central bank actually doing it if they are no longer getting that guidance? This is a huge problem for Wall Street. And if you hold any wealth inside of any of these fiat money products, it's a huge problem for you, whether you realize it or not. The central banks have lost credibility with the markets. Have they lost credibility with you yet? Central banks all over the world are trying to raise interest rates so that they can cut. But by doing that in this very vulnerable place where the whole world is right now, this huge mountain of debt that's rolling over, etc., they're not going to fix the inflation by raising rates. There are too many other countries that have done that, and we've seen it doesn't really work. But that's because of what's causing the inflation, which is central bank money printing. Without forward guidance, how will the markets know what to do? So you see the volatility in these markets. I hope you're ready because it's going to get worse. If you're sitting in there, I don't know why you're still in there. But some people don't have a choice. If you don't have a choice and you have to hold your wealth in fiat money markets like in a 401k or a pension or something like that, my strong suggestion is that you have a truly balanced portfolio where you have gold physical in your possession to offset the risks that you're taking with the fiat money. Obviously, you're going to do with whatever you feel comfortable, but if all your wealth is held in fiat markets, you have all your eggs in one basket that is frankly going down the crapper. Sorry about that. Central banks on a global basis are hiking to try and, it says tame inflation. That's not the real reason. We're going to go into that. But the monetary policy cycle is now increasingly synchronized around the world. So you might recall that back in 2008, that's when the synchronization of the global system really started to come to fore, with central banks letting Wall Street and the banks know what they were going to do, their forward guidance, which, as you know, if you've been watching me, that they have recently stopped. But what this really means is that this is a global issue. You know that. Are you ready for it? Because it really doesn't matter where it starts. It can start in China. It can start in Europe. It can start in the Middle East. It can start anywhere. And it can come home to roost right here, right on your doorstep. They also talk about stable prices are a crucial prerequisite for sustained economic growth. We've talked about this too. What do they really mean by stable prices? Now, if you were and any normal person hearing it, they go, well, yeah, they're fighting inflation. They don't want those prices to go up. But what they're really talking about is the employee's ability to demand more money for the work, so that it goes into a wage price spiral because corporations will pass those costs on. So what they're really actually saying in here is that workers that are requiring increased pay to handle inflation must be stopped. They must raise that unemployment so that workers do not ask for more money. No, that's why you can have a K-shaped recovery, right? With all the money and that income and wealth inequality, all that extra profitability goes to the top echelon, the 1%, and everybody else gets whatever's left. So we must not have those workers be able to ask for a reasonable salary. But monetary policy can't resolve the remaining pandemic-related bottlenecks in the global supply chains and disruptions in commodity markets due to war in Ukraine. It can, however, slow overall demand. So here what they're telling you is they really can't fight the inflation. All they can do is lower demand by increasing interest rates, which means all those corporations that have all of that debt that they have to service, and they're going to be rolling that debt over into higher interest levels, well, they're going to have to lay people off. And it's been quite interesting. We've talked about this recently. It's been quite interesting because on the one hand, we're seeing lots of layoffs, particularly in the real estate sector and the technology sector. But at the same time, you walk down Main Street and what do you see? Help wanted, help wanted, help wanted. So we're in an extraordinarily interesting period because we're at the end of this currency's life cycle. I mean, it truly is as simple as that. But I want you to really keep this in mind because this is one of the things that makes it precarious. And I've told you this so many times, but it's really simple. There's only one way to fight inflation, and that's with deflation. And conversely, there's only one way to fight deflation, and that's with inflation. So for since the 80s, since we started this transition into the current debt-based system, that's really what the central banks have been fighting, has been deflation, right? When the stock markets implode, when the real estate markets implode, when the bond markets, that is all deflationary. So what do? They drop interest rates, they inspire borrowing and spending, they inspire inflation. But they're out of tools. So that's why you have all these dichotomies going on, because we are at the very end. That's why you see all this really unique behavior. According to the IMF, there is a huge number, as you can see, of global central banks that are tightening policy. And that means making it harder to borrow by raising rates and maybe some other policies. You can see where all the loosening was from 2018 because we were being pushed into a recession this was the period when the central bank, the Federal Reserve, was trying to run off its balance sheet and raise the interest rates. They couldn't do it then, and quite honestly, they can't do it now. They've got to do it for their credibility. We'll talk more about that in a minute. But, they have gotten Wall Street addicted to free money. You cannot just pull that punch bowl away. And what about consumers? Consumers this time, unlike 2008, they could have never gotten away with just bailing out Wall Street and the banks. They absolutely had to do something different this time. So they gave a pittance, comparatively speaking, to the people in the form of stimulus so that they could keep shopping and keep those corporate profits going. We saw all of that. But now they're in a tightening mode. What's going to be interesting to see is how far they can tighten before they have to do a pivot and loosen again. Because they have said it repeatedly, and it's just true. How do they stimulate borrowing? By dropping interest rates. Well, when you're anchored near zero, then that's why you go into negative rates. Our government just passed the Inflation Reduction Act, and always beware of any title, because whatever that says, it's probably just the opposite. Do you see the problem? You're starting to see the problem? Because in this bill, they're spending $437 billion. That's all new money. That's new money. They expected to reduce the deficit by raising taxes. They're putting in price caps. They're forcing tax compliance. So, they always say, well, this is going to be paid for by this and that and the other thing. I don't know. Is that true? Because they always promise that, But I don't know. Let's look at this reality. Those are the deficits, the Fed deficits. Does that look like any of those programs that they put in place in the past? And there are many, many of them. Does that look like it reduced the deficit? I don't think so. And this is going to increase the deficit way before it's going to reduce it. You can see where we started in 1971 on this debt-based system. That's what they did in 2008, and it was outrageous. Outrageous. Do you remember how appalled you were at that period of time? And then this is what happened in 2020. You can see it. No, it's not getting better. And what about the debts? This is going to reduce the debts? Let me see. Can you look on this Fed graph and show me anywhere that the Fed debt has been reduced? It's easy to spend other people's money. This is taxpayer money. This is taxpayer money. Because when you reduce the deficits, what that really means is that you are not only spending all of the taxpayer money that comes in, but ever so much more. And we are paying interest on these. So I don't know. I mean, you've got to do what you think is right for you to do, but the handwriting is on the wall. You know what keeps coming up a lot that I've been hearing? The term forced selling. You know what forced selling means? It means stock market and bond market collapse. I was there in 1987 on Black Monday. I know what that looks like, smells like, tastes like, everything. And let me tell you something else. When there is forced selling, everything gets sold with it, except for physical gold and physical silver. There is a higher share of distressed junk debt foretells defaults. So this is in our very near future. The distress ratio leaps to 7.6%, surpassing the 5-year average. That's like danger, danger, danger. So the warning signs are out there. And an uptick in corporate defaults is coming, and probably not that far down the road. And it's not just here in the US, because we're all incestuously interconnected, but now Europe's safest firms of record record biggest jump in bond coupons in decades. That means interest rates going up, bond coupons. Rising costs are headwinds for, I'm going back here for a second. I don't want that yet. Rising costs are a headwind to profitability. You think? I mean, we've seen so many times how these corporate profits just went straight up through COVID-19 and the whole pandemic, etc. Well, now guess what? With the interest rates going up, the opposite is happening. And they've got rising costs on this mountain of debt, as well as the inflation for whatever they're inputting. Blue chip European companies saw the biggest weekly rise in the interest rates they pay on their bonds in a decade, a sign of the increased pressure on corporate balance sheets. And this is what that looks like. Average coupons in high-grade bonds surged the most since 2012. What was going on in Europe back then? The sovereign debt crisis. So are we in a debt crisis right now? Yeah. The debt markets are falling apart. Let's make no mistake about that, because I think what we're really watching is the fiat financial system bubble popping. So that means bonds plus stocks plus everything. The Treasury bond is the biggest thing, because how are they going to bail that out? So the Treasury is going to buy back Treasuries? I mean, this is not going to work. This should tell you how close we are to the end. So we've looked at the government, Treasury bonds, and we've looked at the corporations. What about the individuals? Fed's latest rate hike cost credit card holders $5.1 billion. Yeah, that's per 75 basis point hike. They're going to do a 75 basis point hike again? They might do 50. It doesn't matter. I'm going to show you in a second. But these are credit cards and revolving credit. And you can see that they far surpass where we were in 2020. And you can see also from, well, forever, that the credit card balances just keep going up. But now more people are using them just to buy food and gas and energy and the things that they need. So that's happening while at the same time interest rates are going up. This is a huge problem, and I hope you can see that. Aggressive central bank tightening has piled on billions in additional interest costs. So if the individual could not afford the food at the grocery store and they put it on a credit card and they're not paying that credit card off every month, now they're tacking on all of that interest. And before you know it, some people may be already compounding that interest. You ever getting out of debt when you do that? Nope. Not at all. This is what that looks like. All right, here you go. 75 basis points, 5.14 billion in additional interest costs. But let's say the next one is 50 basis points. That's still 3.42 billion in additional interest costs on these credit cards. And even if they do a 25 basis point move, that's still 1.62 billion. Do you see the problem? And these credit cards are compounding that problem on top of the inflation and the prices that everybody's having to pay for things. So what do you think? You think we might have a distressed consumer as well? So we've looked at a distressed treasury market where the treasury may step in to buy the treasury bonds back. You see the stressed or distressed corporations with higher interest rates and higher costs, and the distressed consumers. I'm thinking we got a real problem on our hands here. With all the central banks having done this, with all the central banks printing massive amounts of money, how could there be this lack of liquidity? Maybe because rather than taking advantage of it and retiring debt and getting in a position or turning around, well, we certainly know central banks have been buying more gold than they ever have just through the third quarter of this year. They're getting in a position to buy up those assets. And we also saw a huge jump in bar and coin demand, up 36% year over year. So those people that have positioned into gold, I mean, okay, here's my hesitancy. This is where you're hearing my hesitancy. I don't think they're going to let you have that opportunity with bullion, which are those new coins and the bars. That's why I only do the collectibles. And you guys know that if you've been watching me, you know that I don't buy that. But people are trying to do the right thing, and people are trying to get in the position so that, number one, the wealth that they've already managed to accumulate remains intact. And then number two, so that you can take advantage of these opportunities as they present. Okay, let's go back to the slides now. Because repricing risks and liquidity difficulties. So repricing risks means the markets go from here to here, okay? And liquidity difficulties render financial markets and non-bank financial institutions vulnerable to disorderly risk adjustments like Black Monday in 1987. Let's see, investment funds. So we're talking ETFs, which don't have to hold a lot of cash typically, mutual funds. So investment funds, liquid asset holdings remain low and could thus amplify a market correction in a forced selling scenario. Because if you bought all this crap on debt, margin debt, or any other debt, and the market goes against you, the market drops, Well, you got a margin call. You've got to come up with cash. And so what do you have to do? You have to sell off some of your holdings, and then that pushes the markets down even more. That's that feedback loop. So you have to sell more, and there you go. You're in trouble. But make no mistake, I mean, the fact that they keep warning us that there might be forced selling is telling you that that's what they expect to happen. They expect a market crash to happen. Now, what will happen to spot gold when the market crashes? Spot gold will most likely sell off. But what will happen to physical gold? Those premiums are going to get bigger and bigger and bigger. This is what's going to save you. So if you haven't started to build that position, click that Calendly link below. Get yourself into a position to weather this storm, because inflation impacts everybody, including the gold industry. What they're doing right now is testing the digital dollar. You know, I mean, they've been putting all of these things in place for the last couple of years, and we keep being told that they're not ready. But look at this, a multi-currency exchange, and that's what a CE is, a currency exchange and contracting platform. Okay, so what we're looking at here are alternative types of monies as payment instruments. And you have public and private. So let's take a look. This includes cash, central bank reserves, CBDCs, CEs, bank deposits, and stable coins. So, you know, I think that even these headers are really interesting, because what they're really showing you is what they're focusing on. No, they're not going to take cash completely away from us. They're going to let us volunteer just not to use it, and then they'll put a chip in it so they can go to negative rates. This is what they're telling us. But they don't want you to know that anything has changed, so they need to keep things as close to normal or what you're used to as possible. So again, cash, central bank reserves, CBDCs, CEs, bank deposits, and stable coins are what the powers that be view as payment instruments. And you can see by looking at the CBDCs where they're questioning some places in retail particularly, right? I mean, basically the CBDCs and the CEs have a lot of similarities. Where they have the question marks, yeah, I'm pretty sure those will be real similar too. And especially in here, because they will be programmable. Right now, the cash isn't programmable, but it'll get there. Give them time. Give them that chip. They will put it in place, and everything that we do is programmable and maybe even set up for, I don't know, social scoring. I told you forever when I saw what China was doing that everybody's watching, and that's coming to a theater near you. Some in Europe all say that they already have that foundation in place. Maybe they have that foundation in place too, because this is the first step aimed at stimulating further work in this space. So make no mistake, this is the prelude to the CBDC, which, oh my goodness, no, they haven't decided. Well, what? Is the U.S. going to be last in issuing a CBDC? I don't think so. And who's going to be part of all of this? I don't know, Wall Street, because they are so trustworthy. And I hope you understand that I am being completely facetious when I say this. So Wall Street tests crypto dollars with Fed, right? Defying the FTX gloom. Now, FTX is a digital cryptocurrency exchange, and that is now in bankruptcy, taking with it a lot of other entities. Some people think that this is a prelude to getting the regulation in place that they need for the CBDCs. I might be one of those people. but I'll let you formulate your own opinion. Network for digital dollars will settle on a distributed ledger that will be shared, okay? Who's part of this? Because frankly, the players are chosen. Bank of New York Mellon, HSBC, PNC Services, Toronto Dominion Bank, that must be a Canadian bank, Truist Financial Corp, and U.S. Bank Corp, along with MasterCard. I like that combination, again, being facetious. This makes me, look, I have never, ever, ever said that this is not the direction that we're going in, because it absolutely 100% is. I will participate when I know who the winners are, when I know who's going to survive, and I have no other choice. Right now, I have a huge choice, and it's right here. I hold it, I own it, it runs no counterparty risk. So let's look at a little bit of leverage, which is, what is this? Well, this is the notional amount of precious metal, meaning gold contracts. The notional, when you see that word nominal, notional, what you know is you have no idea of the amount that is really at risk. These are derivative contracts on gold. And you think with all those derivative contracts that it impacts the price that you see? Yeah, I think it does. Derivatives are a great way to see how banks leverage gold, and they do it with silver too, and they make money on that leverage. And they get you to go, oh, but look, gold is going down. I don't want to buy, I guess I'll buy stocks, or I guess I'll sit in cash, or I'll do some other fiat money piece. And they've got you right where they want you, because this is cheap and easy, and using your wealth for their benefit. Oh, that's a good idea for them, but how about for you? Because physical gold works different. So does physical silver. It works different, because that's a true supply and demand market. So my original plan when we got to the whole other side of this mess was to convert a chunk of my gold holdings, not all of them, because you always have to have a foundation anyway, but a chunk of my gold holdings into the new currency when it had a component of gold in there and was stable. That's when you're going to know it's over, is when they put a component of gold in the currency. But seeing all of this that they're choosing to do, no. I will convert it as I need it. How about you? Because let's take a look at what's happening in the physical world, in this world right here. Because maybe a month ago or something like that, I showed you that the physical collectible coins had broken out. And guess what? That's gotten even bigger. It expands. Can you see that? It had just done a breakout. Well, I would say that this is a definitive breakout. When are you going to position in? Oops, sorry about that. When are you going to position in? When it goes a whole lot higher? Or how about now while you still can, before they've got you completely under their control? Because once we go to a digital currency, they don't want you buying gold. Boom, you push a button. They don't want you buying anything. Boom, you don't agree with them politically. Boom. They have you. And there won't be anything that you can do about it then. So the time to do something is now. Just hit that Calendly link. If you don't have your strategy in place, get it in place. Hit that Calendly link below and make an appointment to see one of our consultants. They can help you create your own personal strategy. The foundation will be exactly the same as mine, but it'll be tweaked to your goals and your circumstance and what you have to work with. But make no mistake, you've got to get it in place ASAP. We are seriously running out of time. I have said right along, 2022 is a very pivotal year. And it's been proven to be a very pivotal year. So how do central banks prepare for a crisis? Record central bank buying lifts global gold demand. Really? Physical gold. The paper gold is a different story. Physical gold demand excluding OTC. So that's the spot market. So all the physical demand in the third quarter of 2022 was up 28% year on year and was bolstered by consumers and central banks. So this goes all the way back to 1971, right? And goes through 2021. Well, what's it look like now? There's 1971, there's 2005, which was actually the bottom of the selling to manipulate the price. But ever since 2010, they've been net buyers. Look at what's happened through 2021. Let's see where we're at in 2022. Central banks bought almost 400 tons of gold in the Q3, which is that light lavender that you see on the screen. And guess what? My goodness, there's 2010 when we went net positive purchases. There's 2018 when the system was starting to fall apart in earnest again. And here's 2022. It is the highest central bank gold buying ever. And it's only the third quarter. What's going to happen in this fourth quarter? They've already surpassed it. What does that tell you? Who knows more about how they are destroying the entire world than the central banks? This is what they're doing to protect themselves. But with the digital gold, which you look at the spot market and go, well, sure, Wall Street's telling me, oh, gold is doing nothing or gold is going down or blah, blah, blah. Digital gold investment was down 47% year on year as ETF investors with significant outflows. These movements alongside weakness in OTC, so that's derivatives, that's over-the-counter demand, and negative sentiment in futures markets hampered gold's price performance, contributing to an 8% quarter-on-quarter drop in the price during Q3 2022. So that's what's controlling the visible price of the gold that you see. This paper gold, of which, just like they can with money, can create as much of it as they want. But in the physical world, there's a finite amount. So you have demand for the physical exploding, and yet the price action that we see called perception management, having people go, oh, who wants gold? Right? I want it. You want it. Clearly, the central bankers want it. And they want it because they know they're destroying everything. They want your money in their system, so it's easy to rob you. I suggest you take your wealth out of the system so that they can't touch it. Because what you're looking at right here is the only financial asset that runs no counterparty risk. She just wants to sell gold. Really? I'm trying to protect you. And how can I tell you to do something that I personally am not doing myself? And I know that's not going to be likely to protect you. I think of myself as a person of integrity, so I got to do what I say and say what I do. or you shouldn't be listening to me at all. Because how many times can you be lied to when you do not know the truth? Every single time. But how many times can you be lied to when you do know the truth? And that's what this site is all about. Me showing you the truth and the things that I'm seeing, because I've been groomed for this moment in time. What will it take for everyone to realize that we are living through the greatest Ponzi scheme in the history of money? From the moment the Fed was born, inflation has been silently robbing you of your wealth, and especially once the backing of gold was gone. But it's not so silent anymore, is it? Have you checked your food and living expenses lately? What most people don't realize is that historically, when a currency is about to completely collapse, it is matched with both record levels of inflation and the illusion of a stock market going up. This will be the next historic transfer of wealth, and those who hold gold will be the few who maintain privacy and control over their wealth. Pay attention closely, because this video will show you the clear process which is about to unfold and exactly what you can do about it while you still have time. Coming up. When will the economy completely collapse, and how can I protect my family and my wealth before it does? I will answer both questions by showing you historic cycle indicators and the current actions of those who are in control of your money. Because we are at the end stage of both the regime and currency shift, otherwise known as the changing world order. There are 6 stages to the shift, and Ray Dalio just wrote this month that we're approaching the final stage. The breakdowns are escalating. And if you understand history, you know there are always winners and losers in every crisis. I'm going to show you exactly where we are, what's coming, and how you can position yourself to win. Coming up. For the first time since they began the tracking in economic history, the global yield curve just inverted. This, of course, includes 26 countries, including the US, the UK, Canada, and Hong Kong. And if this isn't your sign to get financially prepared for a collapse, I just don't know what is. I've been showing the pieces to this Jenga economy falling one by one by one. Well, imagine 26 pieces just got pushed all at once. And when the yield curve inverts, just in the US, it's always followed by a recession, but this is catastrophically different. It's on a global scale, and rates are increasing at the same time, and the entire foundation of our currency is being destroyed from the inside out. It's the end of a currency's life cycle, and they're going to blame everyone but themselves when it happens. If you hold your wealth in the system, you are at the mercy of those driving this bus. And there's only one way to take back control, and that's the privacy and safety of gold. Coming up. So what's the moral of this story? Don't be a deer in the headlights, and don't get caught in this trap. We are living through a time when more people are more confused than they've ever been. One of our clients called it the global confusion. And as she thanked us for helping her to simplify a strategy to protect her wealth, well, our goal is to give you back control over your finances and put you first, making your wealth last forever. But to do that, you must seize the opportunity. Until next we meet, please enjoy the holidays with those you love. Hold them close. And be safe out there. Bye-bye.